Let's say you earn $1,000 by working hard, and you want to invest it somewhere. Then you hear about trading and think it's the best way to grow your money. You put your hard-earned money into trading, thinking you'll grow it after learning how to analyze the market. You place a trade, and then the market goes against you and hits your stop loss. You think your analysis was wrong, so you place another trade, and this time the market goes against you again. Now, you think you're doing something wrong and start learning more about trading. But guess what? Even after that, you're still losing 95% of your trades. Then you ask yourself, why does the market go against me each time I place a trade? Like someone is watching me? Can someone really manipulate the market against your trades? The answer is yes. Let's talk about the truth behind market manipulation. And I'm also going to tell you what you can do to avoid manipulation. The stop hunt game, how they trigger your stop losses. Ever placed a trade with a stop loss only to see the market hit it before reversing in your direction? That's called a stop hunt, and it's one of the biggest tricks used by institutional traders. Big banks and market makers have access to order flow data, meaning they know exactly where retail traders are placing their stop losses. They move the price just enough to trigger these stops, grab liquidity, and then send the market in the original direction. Brutal, right? Spoofing, fake orders to mislead traders. Another sneaky tactic used by big players is spoofing. This is when institutions place large fake buy or sell orders to trick retail traders into thinking there's strong demand or supply. Once traders react and enter positions, these orders disappear, and the market goes the opposite way. This has been used in stocks, Forex, and crypto markets, and yes, it's illegal, but some still get away with it. Broker manipulation, the spread and slippage trap. Think your broker is on your side? Think again. Many brokers use spread manipulation and slippage to work against retail traders. During volatile news events, they widen the spread so much that your stop loss gets hit instantly. And when you enter a trade, you might notice you're getting filled at a much worse price. That's slippage, and it's another way brokers make sure you lose while they win. Pump and dump. How big money creates fake market moves. If you've ever chased a breakout just to see it crash right after, you've probably been caught in a pump and dump. This is when hedge funds and big money push the price up to attract retail traders. Once enough people FOMO in, they dump their positions, leaving you holding the bag. This happens in stocks, crypto, and even Forex. So always be skeptical of sudden, too good to be true price movements. How to protect yourself from market manipulation. Now that you know how the game is played, let's talk about how you can fight back. Here are some key strategies to avoid falling victim to these manipulations. Avoid placing stop losses at obvious levels. Big banks hunt these zones. Watch for fake breakouts.